Two people slip on ice in the same parking lot on the same Tuesday in January. Same fall, same fractured wrist, same emergency room. One of them has health insurance. The other one decided 6 months ago that $380 a month was too much for something they never used, and they'd rather keep the cash and take their chances. Both of them walk into the same ER, see the same doctor, get the same X-ray, the same splint, the same follow-up referral. And then one of them gets a bill for $320, their copay and some imaging fees. The other one gets a bill for $7,400. Same fall, same wrist, same treatment. One bill is 23 times larger than the other. And the reason isn't that the uninsured person got better care or more attention. It's that the hospital has two prices for the same procedure. One for people whose insurance company negotiated a rate, and one for people who showed up without that negotiation behind them. The second price isn't a reflection of the cost of care. It's the chargemaster rate, the sticker price that almost nobody actually pays, except the people who can least afford to. That's the starting point, not the full cost, just the opening number. Because what happens next is where not having insurance stops being an inconvenience and becomes a financial event that follows you for years. My name is Kai, and I spend way too much time thinking about money and why the financial risks people ignore tend to be the ones that hit hardest when they land. If you've ever gone without health insurance, car insurance, or renter's insurance because the premiums felt like wasted money, make sure to subscribe and hit the like button. Because by the end of this, you're going to understand exactly what that gamble costs when you lose, and why the bill is almost always bigger without coverage, even for the exact same care. Let's start with the one most people skip: health insurance. The average monthly premium for an individual health plan in the U.S. runs roughly $400 to $600 for a marketplace plan without subsidies. A lot of young, healthy people look at that number and think, I haven't been to the doctor in 3 years. That's $5,000 to $7,000 a year for something I don't use. I'd rather save the money and pay out of pocket if something comes up. That logic sounds reasonable until you understand how hospital pricing actually works. And this is the part almost nobody explains, because the system benefits from you not knowing. Hospitals maintain what's called a chargemaster, a master list of prices for every procedure, supply, and service. These prices aren't based on cost. They're not based on what Medicare pays or what insurance companies negotiate. They're inflated rates, often 3 to 5 times the actual cost of delivering care, that exist primarily as a starting point for negotiations with insurers. When you have insurance, your insurer has already negotiated that $7,400 wrist treatment down to maybe $1,800. You pay your copay and deductible. The rest gets handled. When you don't have insurance, you get the chargemaster price, the full, unnegotiated, inflated number, the one that was never designed for an individual to actually pay, but that you're now legally responsible for. Let that sink in. The chargemaster exists as a ceiling that gets bargained down by insurers. If you walk in without one behind you, nobody bargains on your behalf. You get the ceiling. The price that Blue Cross would never agree to, that Aetna would laugh at, that Medicare would never pay. That's your price, not because your care cost more, because you had no one at the table. The system doesn't punish you for being sick, it punishes you for showing up without leverage. That $7,400 wrist fracture? An insured person's total out-of-pocket might be $300 to $800 depending on their plan. The uninsured person owes the full $7,400. Some hospitals offer financial assistance or self-pay discounts typically 20% to 40% off. But even after a discount, you're looking at $4,400 to $5,900 for the same treatment that cost the insured person a few $100s. And that discount isn't automatic. You have to know to ask for it, apply for it, and qualify. Most people walking out of an ER with a splint and a headache don't know any of that. Now scale that up. A wrist fracture is one of the cheaper emergencies you can have. An appendectomy, one of the most common emergency surgeries in the country, costs $15,000 to $35,000 at chargemaster rates. A 3-day hospital stay for pneumonia can run $20,000 to $30,000. A car accident with moderate injuries, imaging, and a short ICU stay can generate a bill between $50,000 and $150,000. These aren't rare events. They're the kinds of things that happen to healthy 28-year-olds who thought they didn't need insurance because they felt fine on Monday morning. Nobody plans to fall. Nobody schedules an appendix rupture. The whole reason these bills are devastating is that they arrive without warning to people who didn't budget for them, because they thought they'd budgeted around them by cancelling the premium. And here's the part that turns expensive into destructive. When that bill arrives and you can't pay it, and most people can't pay a surprise $15,000 bill, it can end up in collections. Medical debt that reaches collections can hit your credit report, especially if it goes unpaid long enough. And once it's there, it doesn't just sit quietly. It actively damages your financial life in ways that compound for years. Your credit score drops. How much depends on where you started, but a collections account can knock dozens of points off your score, sometimes more. While none of the downstream damage shows up as medical debt consequence. It shows up as your car loan going from 5% to 9%. Your apartment application suddenly needs an additional deposit. Your credit card APR jumps from 18 to 24. Even your insurance premiums get more expensive because your score dipped. Same paycheck, same job, same life, just pricier across the board. You feel the effects everywhere and can't trace any single one back to the ER visit you had 14 months ago. But that's where it started. One medical bill, unpaid, rippling into the cost of your car, your housing, your job prospects, and the premiums you'll pay on every policy you buy going forward. This is the part most people miss. Not having insurance doesn't just cost you the bill. It costs you the bill at the worst possible price, followed by a credit event that raises the cost of everything else in your financial life. The $5,000 you saved on premiums gets erased by one ER visit, and then the aftermath charges you interest on the damage for years. You didn't avoid a cost. You deferred it with a multiplier attached. Let's put real numbers on this. Say you skip health insurance for 2 years. You save roughly $9,600 in premiums. Let's call it $10,000 with round numbers. During those 2 years, you have one emergency that generates a $22,000 bill. After negotiating a self-pay discount, you owe $14,000. You set up a payment plan, but if it's already been sent to collections, or gets sent while you're trying to negotiate, the credit damage can happen anyway. Your credit score drops 80 points. Your next car loan comes at 9% instead of 5% because of the hit. On a $25,000 car financed over 5 years, that 4% difference costs you an additional $2,700 in interest. Your renter's insurance goes up, and when you finally re-enroll in health coverage, you're doing it under pressure, with fewer good options than you think. The $10,000 you saved is now a $14,000 medical bill, a $2,700 car loan penalty, and a credit profile that will cost you more on every financial product you touch for the next 3 to 7 years. Your apartment application gets flagged. That balance you were carrying just got more expensive because your score crossed a threshold. The total damage from one emergency can easily reach $20,000 to $30,000 when you trace every downstream cost. And you started this calculation trying to save $400 a month. Now let's talk about car insurance, because the math here is even more stark. The average annual cost of full coverage car insurance in the US is roughly $2,000 to $2,500. Minimum liability coverage is cheaper, often $600 to $1,200 per year, depending on the state. Some people drive without any coverage at all, which is illegal in almost every state, but still happens. Roughly 1 in 8 drivers on the road is uninsured at any given time, according to the Insurance Research Council. If you cause an accident without insurance, you're personally liable for every dollar of damage. The other driver's medical bills, their car repairs, their lost wages, and their pain and suffering claim. A moderate 2-car accident with injuries can generate liability of $50,000 to $100,000 or more. That's not a hospital bill you can negotiate down with a self-pay discount. That's a legal obligation, often pursued by the other driver's insurance company, which has lawyers on retainer and no interest in giving you a payment plan. If you're the one who gets hit by an uninsured driver and you don't carry uninsured motorist coverage, you eat the cost of your own repairs and medical bills. Your health insurance might cover the medical side, if you have it, but the car damage, rental costs, and lost wages come out of your pocket. A $12,000 repair bill and 2 weeks of missed work can cost you $15,000 or more, and you have no one to collect from. The person who saved $2,000 a year by skipping car insurance is now facing a $50,000 to $100,000 liability judgment that can lead to wage garnishment, lawsuits, suspended license, and a multi-year financial hole that takes a decade to climb out of. That's not a bad month, and that's a restructured life, and it started with the same logic. I'm a good driver. I've never had an accident. Why am I paying for something I don't use? You weren't paying for something you don't use. You were paying for the one time you would. Now let's talk about the one that costs the least and gets skipped the most. Renter's insurance. The average renter's insurance policy in the US costs $15 to $25 per month. That's $180 to $300 per year. For that, you get coverage on your personal belongings, furniture, electronics, clothing, kitchen equipment, typically up to $20,000 to $50,000 depending on the policy. You also get liability coverage if someone gets injured in your apartment, and loss of use coverage if your unit becomes uninhabitable and you need temporary housing. About 55% of renters in the US don't carry renter's insurance, more than half. And the reason is almost always the same. My stuff isn't worth that much, or nothing's going to happen. Until the apartment above yours has a pipe burst and your living room floods. Until someone breaks in and takes your laptop, your TV, and the camera equipment you use for work. Until a kitchen fire makes your unit uninhabitable for 6 weeks and you need to pay for a hotel, meals, and replacement essentials while your landlord's insurance covers the building. But not your things, not your displacement, and not your lost income. And here's the part that stings. Your landlord has insurance. The building is covered. The structural damage gets repaired. The landlord files a claim and moves on. You're the one standing in a hotel lobby with a suitcase and a debit card, trying to figure out how to replace a bed, a couch, a wardrobe, 3 months of groceries in a destroyed fridge, and a laptop you need for work, all out of pocket, all at once, with no claim to file and no one to call. And the sneaky part isn't your TV. It's liability. If someone gets hurt in your apartment, a friend trips, a guest's kid falls, a dog bites, you're not just replacing a laptop. You're defending a personal injury claim out of your own pocket. Most people think renter's insurance covers stuff. It does, but the liability coverage is the part that can save you from a $50,000 lawsuit you never saw coming. Without renter's insurance, replacing $15,000 worth of belongings and covering 6 weeks of alternative housing out of pocket can cost $8,000 to $18,000. With renter's insurance, you file a claim, pay a $500 deductible, and get a check. The annual cost of the policy is less than what most people spend on coffee in 2 months. And yet more than half of all renters are one pipe burst away from a 5-figure expense they could have covered for $20 a month. This is the pattern across all 3 types of insurance. The cost of having it feels like wasted money right up until the moment you need it. And then the cost of not having it is 5 to 50 times what you would have paid in premiums. And that's the math that nobody does. People compare the premium to zero. I'm paying $400 a month for nothing. When the real comparison is the premium versus the uninsured cost of the event. $400 a month versus a $22,000 ER bill. $150 a month versus a $75,000 liability judgment. $20 a month versus replacing everything you own out of pocket. When you frame it as money I'm wasting, of course it feels wrong. When you frame it as the cost of being on the negotiated side of the bill, the math changes completely. If you took the money you'd spend on all 3 types of basic coverage, health, auto, and renters, and instead set it aside in a savings account as a self-insurance fund, you'd need roughly $50,000 to $100,000 in liquid savings to cover what those policies cover. Not invested. Liquid. Available tomorrow if you slip on ice or someone runs a red light. Most people who skip insurance don't have $5,000 in savings, let alone $50,000. They're not self-insuring. They're just uninsured, carrying the full risk with none of the reserves to back it up. The word for that isn't saving money. The word for that is exposed. If you've looked at premiums and decided the cost isn't worth it, if you've run the real math, you have substantial savings, and you understand the full exposure, then that's an informed decision. Some people genuinely can absorb the risk, and I'm not here to tell everyone they need maximum coverage on everything. But if you've been skipping insurance because the premiums felt like a waste, and you figured you'd deal with it if something happens, that's not a financial strategy. That's a bet. And the odds aren't in your favor, because you're not betting against the likelihood of an event. You're betting against the size of the bill when it arrives, and the bill is almost always bigger without coverage. And when it isn't, the risk still is. The same treatment, the same accident, the same fire, and the person without insurance often pays multiples more, sometimes 3 to 10 times, for the identical outcome. You're not saving money by going uninsured. You're prepaying for a more expensive version of every bad thing that could happen to you. And if you're young and thinking, I'll get insurance when I'm older and actually need it, that's the most expensive version of this mistake. Because the events that generate catastrophic bills don't wait for you to feel ready. They happen on a random Tuesday to someone who felt fine on Monday. The whole point of insurance is that you can't time when you'll need it. If you could, it wouldn't be insurance. It would be a scheduled payment. On what separates people who recover from financial emergencies from people who get buried by them isn't always income or savings. Sometimes it's one decision they made when nothing was wrong. A $20 renter's policy, a $150 car insurance payment, a $400 health plan they resented every month. That absorbed a hit they never saw coming. Every dollar you save by skipping coverage is a dollar you're betting you'll never need to spend 20 of. That $380 a month you cancelled because you never used it. It was never for the months you didn't need it. It was for the Tuesday you couldn't schedule, when the same fractured wrist cost you 23 times more because you showed up alone. The premium isn't the cost. It's the membership fee for the negotiated price list. And the invoice for skipping it doesn't arrive at cancellation. It arrives when you're already injured, already in the ER, already being treated. And by then, the math is done.